Welcome, everyone. I'm Clark Merrefield, Senior Editor at the Journalist Resource. Thank you for joining us for today's webinar, co-hosted with EconoFact out of Tufts University on the economic consequences of the ongoing war in Iran. Our panelists today are Binyamin Applebaum, lead writer on economics and business for the New York Times editorial board; Nicholas Bloom, the William D. Eberle Professor of Economics at Stanford University; Michael Klein, the William L. Clayton Professor of International Economic Affairs at Tufts University and Executive Editor of EconoFact; and David Victor, Distinguished Professor of Innovation and Public Policy at the University of California, San Diego. For those of you in the audience, please put your questions in the Q&A box, not in the chat box. This webinar is being recorded, and we'll have the video up on YouTube as soon as we can. We'll get to as many of your questions as well as we can after brief remarks from the panelists. Binyamin will discuss how the conflict began and where it stands, followed by David on the effects on oil supply, Nick on economic uncertainty stemming from the war, and finally Michael on other macroeconomic effects. That's it for me for now. We're going to jump in. Binyamin, we've entered week 3 of this war. If you could just summarize briefly, how this conflict began, what do we know about why the U.S. started this?
So the big picture, which probably is familiar to most of you, is that on February 28th, the United States and Israel launched airstrikes against Iran for the second time in the last 12 months. Those airstrikes continue now. We're now in the third week of airstrikes, and Iran has responded with its own aerial assaults as well as with interventions in the Strait of Hormuz, through which a significant portion of the world's oil flows to markets and consumers. It's a mess, basically, and we can talk more about the economic dimensions of the mess, but geopolitically, we are now in unprecedented territory. We've got multiple nations in the Middle East under attack, feeling tremendous strains on their economies and on the safety of their civilian populations, and no clear way forward. The United States has not particularly articulated what its goals in this war are. President Trump at various times has talked about desiring regime change in Iran, about wanting to prevent Iran from developing a nuclear weapon, but it's not clear how he intends to get there or how we'll know when he's gotten there. And so we're in this strange situation of being passengers on a train without a clear destination.
Great, thank you. David?
Sure, thank you. It's great to be with you today. I guess today's event is sponsored by the word mess, because when you look at the oil markets, it's the same situation. I guess I'll say two things about it. First is just the size of the disruption is massive, widely reported, biggest in history. It's volume and time. It's up to 20 million barrels a day are typically flowing through the Straits of Hormuz. And the time so far, we're 20 days in, so that's 400 million barrels. Up to 400 million barrels. That's the size of the releases that have already been announced from the Strategic Petroleum, coordinated releases from the Strategic Petroleum Reserves around the world. So that gives you a sense of why the markets didn't immediately calm down when they saw these releases. In the real world, we haven't lost a fully 20 million barrels per day. Some cargoes are still going through the straits. There are ways of getting oil around the Strait of Hormuz. And there'll be after this a big, kind of doubling down on these alternative exit strategies, but that's not the situation today. So that's the first point, is just the size of the disruption is enormous. Second is about the markets themselves, tremendous volatility in oil prices. And I think for two reasons. One is the markets don't really know who to believe because of all the things that Binyamin laid out. There isn't really reliable information about what we're doing, what we've actually damaged, what the other damages are in the region, and so on. And there hasn't already also been a serious program to plan for the aftermath of this, or even the running of the war. Normally you'd build up and you'd work on what the minesweeping operations and escort operations are going to be. You'd work on coordinated releases in advance to send a signal to the market. You'd work on all kinds of other things. And basically, as far as I can tell, none of that happened. And so they're playing catch up, and nobody really knows what to believe. And so the possibility that large volumes could be absent from the global markets for even longer than we've seen, a lot longer than we've seen, that's what's really spooking the markets right now.
Thank you, David. Nick?
I was going to pick up on a topic that Benjamin and David already raised, which is uncertainty. Yeah. So weirdly, I started my PhD on uncertainty 30 years ago. So I've been studying this for a long time. And first thing to point out is it's damaging. So you can imagine that higher uncertainty leads firms to pause on hiring. They're not going to hire new people if they don't know what's going to happen. They pause on investment and particularly on research. And this thing can take a while to show up. So I'll give you an example, which is Brexit. So Brexit happened in my homeland. You can probably hear I'm British. And initially you didn't see a lot. But after 10 years, the Brits are about 5% poorer in terms of GDP. It's about $3,000 per person, which is huge. And I kind of think of it's like, we're having some part of a house extended. It'd be like using super cheap timber in it. You might not see a problem in, week one, month one, year one, but at some point it's going to show up. So I think this is kind of a festering long run issue. There are two problems about uncertainty around Iran. One smaller picture, one bigger picture. The smaller one, Benjamin and David covered very well, which is we have just no idea what's going to happen. I mean, is this thing going to last for another week, a month, a year? Is there going to be regime change? What's even happening right now? You've seen from examples like Syria, from Iraq, from Afghanistan, these things can take years to play out. So I think we're at just a total fog. The bigger picture is Trump himself and the current administration is just a massive generator of uncertainty. Somebody said he's a one-man uncertainty machine. And you just see this and all these measures of uncertainty, they spiked in early 2025 and they just remained incredibly high. Now, from talking to folks, there's a few theories out there. One is, look, this is how he ran his businesses in real estate and in entertainment, that you keep the other side guessing. You continuously change your mind. His art of the deal thing is you just want to kind of leave everyone else unprepared. So we should be expected to see more of this. We've had, ICE raids and the Liberation Day and the threats on Greenland and Venezuela and now Iran. And so this thing is going on. Another more cynical claim I've heard is that he wants to keep the Epstein files off the headlines. That's like kryptonite for his base. And so either way, what we've seen is just over a year now of continuous uncertainty. And I think we're going to see this going on. Why is this a problem? Well, it is already starting to damage labor markets. So if you see in the US, there's what's been called the great hesitation because hiring rates are well down. And a big driver of that is business is just uncertain. And I think if this continues, we're going to see a speed reduction on the US economic growth.
Michael. We can't hear you, Michael. Nope.
Ooh.
Okay. Yes. I think we're good. Still not hearing you.
I can jump in while we're waiting for
Sure,
him.
please. Yeah.
I was going to say, I think uncertainty is clearly a key theme here and one we should talk more about. There's also the certain stuff that's happening in the short term. And I think airlines are a really useful microcosm for thinking about the short-term economic effects of what's happening in the Middle East. They're visible. You can sort of see the units moving around, easy to measure, et cetera. And we're sort of seeing three discrete phases so far. The first is that a bunch of economic activity is just not happening because of the war. Those are the flights that have been grounded, thousands of flights at some of the world's major airline hubs. And that's playing out in other economic areas as well. The second is you're starting almost, within a few days after the conflict began, you saw airlines beginning to reroute flights around the conflict zone, around the affected airports, a revival of economic activity, but that economic activity happens at greater expense. You can see on a map that the routes are being bent and every mile in the air costs money. The price of fuel has gone up. And so economic activity is resuming, but at a higher cost. And then the third phase, which has already begun, is the adjustment phase as the economy begins to figure out new ways of doing things. And I thought it was interesting already last week, you saw airlines like Lufthansa and Qantas, which are not reliant on those Middle East hubs, adding flights to their schedules to connect Europe and Asia. Most traffic between Europe and Asia now flows or had flowed before the war through these Middle Eastern hubs. And you're already seeing airlines on either side of that equation beginning to adjust and plan for a world in which that's no longer true. I think you can map all three of those kinds of things onto a lot of other economic areas, even before you begin getting into the question of what the long-term effects are going to be.
Thank you, Benjamin. Michael, you want to see if we can hear you now?
No. I'm happy to jump in and talk about uncertainty
Sure,
in
sure.
oil
Please,
supply.
please do. Yeah.
I mean, obviously the big uncertainty is about how long this goes on and how much disruption we have for seaborne travel, and we'll talk about that. I think the really big question is how much damage is being done to the infrastructure. And that's important because of the export potential. So, for example, here we are on a Monday. Over the weekend, there were, from President Trump himself, reports about the damage that we did to Karg Island. Not clear how much damage has been done there. That's the dominant export hub for Iranian oil. And, like Iran or not like Iran, Iranian oil is an important part of the global market. And so there, it seems like more damage is being done for the long term. Meanwhile, a lot of the infrastructure seems to be in reasonably good shape. For example, the Qataris shut down all their gas operations as a precautionary measure, also because there's no place for the LNG, liquefied natural gas, to go. Um, that should be relatively easy to restart with minimal damage, and that 20% of global LNG supply will come back online as soon as the ships have a way to get to and from Qatar. So I think this is a tremendous amount of uncertainty about what the longer term picture looks like after kinetic operations.
Can you hear me now?
Now
Yes,
we
yes.
can.
You are
Great.
back. Yeah.
So speaking of uncertainty, and also, Nick mentioned that he wrote his dissertation 30 years ago. I started studying economics almost 50 years ago. This was in the 1970s when we were faced with a supply shock. And macroeconomics had to sort of come to terms with this. And what we learned was that supply shocks are really hard to deal with because usually you think of monetary policy trying to raise rates in order to fight inflation or lower rates to try to fight unemployment. But a supply shock affects both of these. And oil isn't the only supply shock now. Tariffs are a supply shock for the United States and other countries. The cutoff in immigration is a supply shock for US labor markets. The uncertainty is like a supply shock. And these things also have a demand shock aspect to them as well. Oil price rise, the rise in oil price is like a tax on people's ability to spend, as is tariffs. So what we're seeing is that the economy had not been doing great in February before the 28th, before the invasion. The inflation rate was still well above the Fed's target of 2%. It was 2.8%. The unemployment rate was 4.4%. And these numbers are going to get a lot worse once we get accurate numbers for March. So the Fed is in a real bind. And it's not only in a real bind because there's a supply shock, it's in a real bind because there are real concerns about the Fed's independence. The independence of a central bank is a very hard fought thing to obtain, and it's very important. And up until recently, the Federal Reserve and many other central banks had gained a real element of independence, which made their jobs easier because if people expect inflation to be lower, that helps keep inflation lower. But now, with all of the attacks on the Federal Reserve and the nomination of Kevin Warsh and the concerns that he's going to do the president's bidding, inflation expectations have been rising anyway before the oil price shock. And now this is going to contribute to it. So central banks tend to look through energy price shocks because they think of them as temporary and try not to respond too much to those. Here, there is the uncertainty about the length of the war, the uncertainty about what will happen to oil prices, the uncertainty about the Fed, the uncertainty about what's happening with immigration, how a lack of enough workers could lead to rising prices. So this is an incredibly challenging time, and the Federal Reserve is going to be faced with some really difficult choices to make in the next half year or so.
Yeah, I will question here from the audience, and I'll throw this to you, Nick. It's sort of trying to get at, of course, uncertainty is not something that markets like, and people want to have at least some idea of what the risk is moving forward. The the question is, can you suggest a timeline of economic impacts we might look for if this conflict continues to go on for 2 weeks or a month or 2 months or even longer? What are those impacts as this drags out for weeks and weeks or even months?
So already we've heard from the panel, and Benjamin, for example, talked about airlines, things that are happening here and now. So I'll talk about uncertainty and I'll talk about one other big one. So uncertainty, I mean, the best analogy is actually Brexit. We have a very clean event study there. And everyone thought Brexit would be a disaster at the time. It wasn't actually. Nothing that bad happened and the economy kind of chunted along. What you see is 10 years later, in fact, it's almost 10 years after the vote now, there was a big loss in GDP. And it's because a lot of longer run investments in particular get paused. So, firms thinking, well, we'll do this R&D program, we'll build this new factory, let's just wait and see. And so that tends to accrue over time. The other area that oddly I worry about and has been really the saving grace for the US economy is AI. And just to explain a minute, so just to backstop, there's been a number of headwinds in the US right now, less immigration, trade has been harder, there's been higher uncertainty, but AI has been driving, a lot of what the growth we've seen directly and indirectly. And the issue for AI is that the oil price spike is putting up energy prices pretty sharply, and it hasn't quite immediately been its feed through. AI is an incredibly energy intensive technology, way more than any others. And indirectly, there's also political pressure now building in the US to regulate it. You've seen Bernie Sanders has been demanding, end of data centers. So if energy prices go up, you can follow the dots to, there's more political pressure to push back on AI and its energy use. And that could be another big issue for US growth, actually, I could see coming reasonably soon.
On the uncertainty issue, we used the index that Nick and his co-authors put together. And Nick mentioned the spike in uncertainty at the beginning of Trump's term. What we found in a memo that we published on EconoFact is that when uncertainty spiked, typically what happened is the dollar strengthened because it was seen as a safe haven. The two periods where that did not happen, when uncertainty spiked, the dollar actually weakened, were the first 4 months of Trump's first term and the first 4 months of Trump's second term. So this sort of also speaks to concerns about what could happen to financial markets, something we haven't yet sort of really brought up, but there are a lot of concerns now about sort of risk premium in financial markets, people talking about private credit being a real threat and something that we can't really recognize, because a point was made that when, companies go bankrupt, it becomes public knowledge. With private credit, there's a lot of sort of behind the scenes things going on to, lower the interest payments or add interest payments to principal or something like that. So there could be a lot more distress in private credit than is evident.
Just briefly on the issue on the AI dimension is really interesting. This is a reminder that in some ways the situation in the United States or North America is quite different from the rest of the world. Our price of oil, and therefore the price of things that people see on a regular basis, gasoline, for example, jet fuel, that comes out of the global market. Our natural gas prices, though, are very different because of the horizontal drilling and fracking revolution. So natural gas prices in the United States are about $3 a million BTU. They've bounced around at 10 times that level in Europe because the Europeans are very dependent on imports of LNG from the United States. And some of those imports are going to be drawn to Asia as basically the Qatari's production that would have gone to Asia is not available. So for a lot of the world, gas itself is coming out of a global market, not quite as fluid as the oil market. United States, not yet. A growing fraction of our gas is being exported as LNG, so eventually there'll be a tighter coupling between US gas prices and global gas prices. We're not there, not even close to that point yet. And so this really matters for a lot of things, including the AI revolution, because so much of the power supply for AI data centers is the electricity for that is more or less priced against the natural gas market. The price of electricity is a function principally of gas prices and some other factors, cost of transmission and things like that. And so that's really insulated the United States from some of the harm that we might otherwise see immediately flow at least into the data center and electricity or electrotech facing parts of the American economy.
Yeah, great. Thank you. We also have some questions coming in about what are the effects potentially on alternative energy supplies. It's of course still just week three of this, and what would be some of the headwinds or any potential sort of shifts in a long-term movement away from oil and towards other sources?
Yeah, I mean, I can start on that. Yeah, we're only 3 weeks in, but the opining on this matter happened immediately, or if not before the attacks. I think this is a little bit like one of those ink blot tests. You see the price of oil go up, price of a lot of other energy that more or less comes out of the oil market, at least globally, that goes up. And then what's the response? In Europe, the response has been to double down on their energy transition, to double down on the emission goals, to double down on reducing their dependence on gas, including imported gas and oil from Russia, more renewables, more nuclear. The head of the European, uh, many senior European politicians have now said that the turn away from nuclear was a strategic mistake. So that's kind of clean. That's biasing in the clean direction. I think right now, at least at the federal level, the U.S. policy has been to double down on more oil production. And so we see these radically different views about what to do in response to this. All that said, the as the price of oil and other conventional fossil energy goes up, the rivals are going to become more competitive. They're actually probably create a boost in demand for that and all kinds of supply chain crises associated with that. But that should be beneficial for clean energy over the long term. But I think insofar as the future of energy depends on political choices, to me, what's interesting is this divergence in responses as opposed to the convergence.
I'd just note a couple of things from history. The first is that the oil shocks of the 1970s really fueled the innovation in renewable energy that we are reaping the benefits of today. It wasn't immediately realized or implemented at a mass scale, but the technologies really came out of that era. And so you definitely can see a response. One way of sort of responding to uncertainty is to say, well, how do we reduce uncertainty going forward? How do we become more energy independent? And I think you could certainly imagine companies gambling on that and investing in new clean energy technologies. I think nations may also feel that incentive. China has made a strategic imperative out of becoming less reliant on Middle Eastern oil. It is still, however, heavily reliant on Iranian oil in particular. And this is going to be a reminder for China's leaders of the benefits of reducing that reliance long term. Obviously, in the United States right now, our leaders are taking a very different set of conclusions, but you could imagine us under a future administration similarly concluding that this is a reminder of a strategic vulnerability that we ought to reduce. But I'd note that there's a flip side historical lesson as well, which is that after the Gulf War conflicts a couple of decades ago, the way that those countries rebuilt was by pumping oil and making it available cheaply. They went hard at the market as a means of restoring their own economic fortunes. And you'll probably see that again too. I mean, if you are a country in the Gulf and you now have a big bill to pay for rebuilding and you are in one business and one business only, you're going to try to do more of that business.
So I would follow up with that by mentioning four things: Cadillacs, Toyotas, Hummers, and Priuses. In the 1970s, the United States and other countries used a lot more oil per dollar of GDP. And what happened, along with the alternative sources, is greater conservation. And so we went through that. And then, you think about the Hummers when oil was very cheap. You don't see many Hummers on the road now. You see a lot more electric vehicles. So there's also sort of that aspect. And in a way, we have to be a little bit careful about using the 1970s as a comparison, even though I started off with that. And the two main reasons are the lower dependence on oil for a given amount of GDP. And the other is in the 1970s, we had a decade of inflation. So inflation expectations were really baked in. So we're at this point where we're using less oil per dollar of GDP. One concern, though, is that inflation expectations might not be as baked in, or low inflation expectations might not be as baked in as they were 5, 10 years ago.
We have a couple questions here about the labor markets, which were mentioned briefly, but I think that we should jump more into that and interest rates for homes. These are two big issues that affect people's lives very directly. We can start with the job markets. Not as high of unemployment as we've seen in history, but it is turning out to be a tighter market. Um, how is the conflict affecting the job market?
Happy to jump in on that. So,
Sure. Yep.
labor markets kind of 5 out of 10 right now, if I was to give an overall number. So if you want to look on the good side, unemployment is relatively low. I think it's 4.6, 4.7%. And just to put that in perspective, the average post-World War II in the US is 5.5. So unemployment is low compared to long run average. And we're still seeing some job creation. So what is the bad side of it? Job creation levels are very low. I think a lot of that's because of the anti-immigration policies. So immigrants are big drivers of job creation. If you go back 2-3 years, we were creating a couple of 100,000 jobs a month. Now it's close to zero. The other, I think, by far the most worrying sign is it's very hard to get a new job. So hiring rates are down. So separation rates is and how quickly people leave or get fired is down, but hiring's also down. So it's kind of like remember that movie Frozen? It's I can't remember. Elsa. It's frozen the labor market. It's kind of it's not good. And I teach at Stanford, and Michael and David are also teaching, and then come in contact with a lot of undergrads, and they're kind of nervous because it is harder to get a job. What will the event in Iran do? I think it's going to make that worse. Why is that? Well, Econ 101 tells you if you're a firm, you don't go and hire a new employee if you're uncertain. Why? Because that hiring action involves some sunk costs, and if you make a mistake, it's an expensive mistake, and if you don't know the future, you tend to pause. And the same goes with investment. So, investment generally creates employment alongside it. So my prediction is it's going to chill the labor market even more. So we may not see unemployment go up, but I think what we're going to see is it's a lot harder to get a job. So if you're in a current job now, don't leave it. It's going to be difficult to get a new one. If you know folks looking for a job right now, that's definitely a tricky situation to be in, and it's just got worse.
And with interest rates, the interest rate that you pay is, reflects what people expect inflation to be. And as inflation expectations start to rise, the interest rates will rise as well. And, that inflation may or may not be realized. So it could actually turn out to be very expensive to borrow money now if inflation doesn't end up being as high as you thought it might be, and you're paying back in more expensive dollars than you expected. So with higher interest rates, mortgages are going to become more expensive, car loans are going to be more expensive, borrowing for big ticket items are going to be more expensive. For companies, it's more expensive to invest. And also, as I mentioned before, with these credit spreads, with more concerns about risk, companies, if they want to float bonds on the market, that's going to become more expensive. And if stock prices continue to fall, you can't raise as much money through equities as well. So financial conditions probably will deteriorate, would be my guess, based on what's going on right now.
And I just want to underscore something in what Michael said. For your average consumer who's thinking about buying a house, when inflation expectations drive up mortgage rates, they just experience that as an increase in mortgage rates. That's bad enough. That's going to tend to diminish the number of people who want to buy houses and the amount of money they can spend on those houses. For corporations, it's even more impactful because of, as Michael pointed out, the fact that there's a concern that if those inflation expectations don't hold up, you get trapped in a situation where you borrowed expecting higher inflation, and then your revenues reflect lower inflation, and corporations are acutely attuned to that risk. And so for them, this is doubly impactful. It makes it even less likely that they will invest under these circumstances.
And the great historical example is the late 1970s, early 1980s, when inflation was very, very high. Volcker comes in to take over the Fed, inflation drops. So people find that it's very, very expensive to pay back the loan. So we have the Latin American debt crisis, we have the farm crisis at that time. And, that's a lesson that we should all be heeding.
We had a question about the de-dollarization of global oil trade. It's certainly not something that I know much about. David, is that something that you can sort of tell us what that means? And
Yeah, I would be curious. I think that the dollarization of the oil trade is connected to the dollarization of trade and the role of the dollar. And so maybe others can talk about that across the picture, because I think that's the big story. All in a sense is trailing.
So the dollar is what's called a vehicle currency. So a huge amount of international trade, an even bigger amount of world financial trade, is denominated in dollars. And interestingly, it's not only trade with the United States, but trade between two other countries. say, Brazil and Italy, the trade will be in dollars often. So the reason for this was the dollar was seen as, sort of a stable currency, that there was a rule of law in the United States, and all these things are now being threatened. There's discussion of the lack of dollar dominance, of the dollar falling out of what's loosely called its reserve currency role. There's a lot of inertia in this. It's sort of like, I'll use it if other people will use it, and they'll use it if they think I will use it. So, it becomes sort of a self-fulfilling prophecy. Something like that is hard to break, but it does break, because we saw, for example, after World War I, the pound had that role, the British pound in the world market. And then due to the disruptions of that war, there was this interwar period where there wasn't a dominant currency. Since the end of World War II, the dollar's been the dominant currency. But if anything's going to threaten it, it's, events of the last few years.
I actually would push back against that a little bit. I think in the United States, we tend to overstate the risk to dollar dominance. We tend to see it as tied to our own fortunes when it's actually tied to our relative fortunes. And we saw it during the COVID pandemic when our fortunes plummeted, an expectation that it would be bad for our role as the world's dominant financial center. But what happens is that if everyone else is in worse shape financially, if they're experiencing even greater pressures, the United States can look like the safest port in the storm. And we saw capital rush into the United States during a period when the US didn't really look like a great place to invest because everyone else looked even worse. And so the real thing to go back to that World War I example, what happened is that the United States offered an alternative to Great Britain, and so global financial markets moved from the pound to the dollar. There's no obvious alternative at the moment, and so it almost doesn't matter how badly we're doing, and one can overstate that, but you really need to think about what the alternatives are to the dollar. And what we've seen during recent crises is a pattern where the dollar has counterintuitively strengthened its role as the world's currency, precisely because those alternatives don't really exist.
Yeah, I wouldn't disagree with that. I think there's a lot of inertia in that. And as Binyamin said, there isn't a good alternative right now, and it's unlikely that we see one really emerge. The euro, there are a lot of concerns about Europe and energy, as David was speaking about. China has all these capital controls. So, I wouldn't disagree with that. It's something that people bring up. I don't see it happening anytime soon, though.
We have questions about, and we've seen media coverage of whether what's happening with this war, with private credit markets, means are we on the cusp of a 2008 style crisis? Is there true, systemic risk for markets because of this? Is private credit comparable to the collateralized debt obligation problems of that crisis? Do we have any good answers on that from anybody, or anything that we should be looking forward to say this is really going to tumble into something much, much bigger?
Happy to give a quick kind of response to this. So if you look at the US over the last 70, 80 years, you see recessions happen on average once every 7 or 8 years. It's also the case that they're independent. So if you had a recession last year, there's no greater or less chance of there being a recession this year. So a collapse in private credit that could potentially, like in '08, lead to a recession is something that could happen. It's very unpredictable. In fact, Bob Hall, one of my colleagues at Stanford, who used to head the MBR Business Cycle Dating Committee, said it's a bit like Anna Karenina. He said, that initial line that happy families are all alike and unhappy families are all different. Well, the economy is like that. Expansions are all alike, we're steadily growing and adding jobs and adding investment, but recessions are completely different. There's the Gulf War, there's the, Michael mentioned the Volcker crisis, there's the financial crisis, there's COVID. So I think this, one of the easiest things you can say is it's very hard to predict crashes and recessions, because otherwise policymakers get in front of them. If I see it's coming, I get in front and stop it. So what they tend to be is A, unpredictable, B, they happen about every 7 or 8 years, but they're all different. So yes, there could be, private credit. I was listening, something else that was mentioned was Energy is causing issues. Chapter 12 bankruptcies, which are to do with farmers and fisheries, are rising rapidly. Why? Because energy prices are putting up fertilizer prices, which is pretty critical for them right now in the spring planting season. Will that lead to recession? Probably not on its own, but everyone should be aware that any one year there's a 15% chance of recession. They're impossible to predict, but when they happen, they tend to happen quickly, and they tend to look different from every other one before them.
I would add to that in 2007, nobody thought there's going to be a recession. Well, very few people thought there's going to be a recession, the deepest since the Great Depression within 9 months or so. The real concern, I think, is one of leverage. So what happened in 2008 was that there was a lot of leverage and people didn't understand the full extent to which people were exposed to risk. And right now, we've come up with a number of ways in which companies and individuals are exposed to risk. I guess the question is whether or not these could kind of compound upon each other and lead to a cascading effect like it did in 2008. But, as Nick was saying, these things can happen seemingly out of the blue. And after the fact, everybody's got a good explanation. But, beforehand, they come as somewhat of a surprise.
And if you have this cascading recessions, which will soften demand for energy, notably oil, along with, people are running out of ammunition, so we will see an end or a phase down of the war, the kind of normal war operations in the Gulf. So then you're going to have supplies come back online, an outlook for demand that's softening, and so on. You could easily see oil prices come down very, very rapidly, which will create its own crisis for the regions. And so many of those economies, as Binyamin said earlier, basically are indexed to the price of oil.
We have a specific question here about the positive and negative impacts for the southern part of Texas, where oil is refined. David, maybe you can speak to that. The oil that is produced here in the U.S.
Well, you've seen just in the last few days reporting on the incredible increase in valuation of essentially all the Western oil companies. Anyone who's not too tethered to getting their product out of the Gulf, and that includes Texas. So there's going to be a huge windfall. The valuations are not yet NVIDIA, and they won't get there. But to first order, the value of a company, of a well-managed company that produces oil or natural gas, is indexed to the price of their product. And for the U.S. producers, it's indexed to the global price of oil. So this has been an enormous benefit. It'll be trickier to figure out what this means for refiners because they have also higher input costs. We've seen gasoline and product prices come up very quickly. They may actually be stickier going down, and so that could be beneficial to them. But the benefits to that part of the economy are less clear cut than the absolute unambiguous and massive benefits to anybody whose product is linked to the price of oil.
David said, for a well-managed company, there's a big windfall. For a poorly managed country, there's a big windfall as well. So Russia is going to be a big beneficiary of this, not only because of the increase in the price of oil, but the, I guess, relaxation of sanctions on Russian oil. And so this has, lots of sort of political and military implications.
So can I just comment? So 10 days ago, I was to and from India over a period of a few days. So I did the flight routes that Benjamin was talking about, spending a lot of time in the air, basically avoiding airspace of any country that was at war, which took a while. One of the things that really struck me on the ground in India is how the Indian relationship with Russia has continued for obvious reasons. They're highly dependent on a lot of imports from Russia, including oil. So they had a waiver already that allowed them to import Russian oil. We had some of that Russian oil still flowing. So I think one of the really interesting questions for empirical economists as things settle down will be what was the effect of basically relaxing the sanctions on Russia, because the practical effect was already muted by the fact that the oil was still flowing, just like some of the Iranian oil and other products were still flowing through the Strait of Hormuz because they had issued a security guarantee with relative degrees of credibility that those ships wouldn't be damaged during their transit. So I think this is it's too early to tell right now, but it's going to be phenomenally interesting. And if prices come back down quickly and then we reinstate sanctions, then the benefit to Russia could be short-lived. But that's I think it's unknowable right now what that's going to look like over the long term.
We have a few questions about specific effects on U.S. consumers and households, and I think the gas prices are probably the most uh, at the front of people's minds. But how might those impacts on households evolve? And we have another question about what can ordinary U.S. citizens do to mitigate any economic damage? And perhaps the answer is there's not much, but um, would have been what are the effects on households, and is there anything that people in their own lives have control over?
Well, a higher tax price is kind of like a tax that you're paying, but you're paying it to the oil companies, not to the government. And if you're paying more for gas, you're buying less of other things. So it's going to have an adverse effect on consumption. Consumption seemed to have been sort of relatively strong, although I think it was sort of by income group. So people at lower levels of income, their consumption wasn't buoying up the economy. But maybe, with the higher gas prices, consumption will weaken. And consumption is like 60% of GDP. So this could really have an adverse effect on overall GDP growth.
Yeah, I was going to mention, as Michael said, kind of point out, kind of oil price 101 is it tends to be very regressive. So oil prices will rise, which means gas prices and energy prices rise. That's also going to put up food prices. So, it's increasing fertilizer costs and energy prices for farmers, which is going to see its way into higher food prices. If you look at who spends most of their budget on oil and food, it tends to be lower income folks. So if you're in the top 10%, top 5%, it's typically not a big issue. It's not a big share of your spending. But if you're in the bottom half, and particularly the bottom quarter of Americans, it's a major cost. So this, I think, is going to feed into these concerns about the K-shaped economy. The K-shaped economy is more about income. That, the top quarter of Americans have done pretty well off, the top 10% really off kind of stock market and AI boom, etc. But the other half hasn't. And now we're seeing a similar dynamic from this in terms of cost of living. So that, I think, is a major concern as an economist. Inequality, particularly from changing prices, isn't something you want to see. And I think this is going to increase costs overall, but be also inequality. The other thing, just to pick up on earlier, for those who are net debtors, I think this has clearly put up expected interest rates, and it'll be putting it up now. It was interesting, by the way, that if you see that Europe and Asian central banks are expected to put up interest rates in the US, there isn't that forecast. And in part, it just reflects political pressure on the Fed, I think, at this point. But it's, all else equal, is clearly also going to put up the cost of borrowing.
Yeah, I mean, the question of how an individual sort of navigates something like this is very difficult. This is mostly you're just in a boat and you're on the tides and you're going to get carried where they go. But I would say that the borrowing thing, while it's not great for the economy to give people this advice, is something that people do control. And this is a moment when, if you are borrowing to fuel your consumption, you're going to be paying more to do that. And by borrowing less at this moment, you can reduce your long-term costs and potentially save your resources for a period in which every dollar you have or control will go further.
What's the response been about this conflict from business leaders? And the person in the audience is wondering why business leaders perhaps seem to have not pushed harder for this to end.
I can address that because I've spent a fair amount of time talking to business leaders about their interactions with the Trump administration. And the overarching theme that you hear repeatedly is that what they learned during the first Trump administration is that there is almost zero value, and indeed significant negative value, in confronting the president or in criticizing him publicly. That is a way to attract his attention and to incur consequences that will be bad for your company. And so they have focused all of to the extent that they want to communicate with this administration or share with it concerns about the way that its policies are impacting their businesses, which remains something that businesses really want and need to do. They do it quietly, they do it behind the scenes, they do it through intermediaries. They have learned not to do it in public. And that is why you are not seeing corporate executives talking about this in public. There is almost no one who thinks it's a good idea for their business to be seen talking publicly about their concerns with Trump administration policies.
Yeah, and just to build on that, you'd think the oil industry would be, in some sense thrilled about high prices. And in the short term, there is a huge benefit to them. But you got to be, if you're leading a big oil and gas company, you're looking over multiple administrations to the future. You got to be worried about political support for your industry. You got to be worried about what the backlash or the pendulum swing against the industry looks like. And so these gyrations in price and these huge windfalls are create their own political headwinds.
What other industries besides energy and fertilizer is one that's come up, about 30% of world fertilizer exports go through the Strait of Hormuz. What other products, what other industries go through the strait, and what might be the effects on them?
Well, there's I mean, that's a pretty big deal, what you mentioned already.
Mhm.
A huge amount of the petrochemical industry more or less indexes back on refineries that either are in the Gulf or are near the Gulf. Think, for example, India's modern refinery that was located and designed to be one of the world's most modern refineries, could handle all different kinds of crude oil, was all based on the logic of being a day's sail from the Persian Gulf. So the disruption there is massive. We haven't talked much about natural gas today. For countries that import a lot of their total energy as natural gas, liquefied natural gas, think Korea, think Japan, a little bit China, India. This has been tremendously disruptive because the routes, I mean, they can't redirect quickly. There is a spot market, but it's a relatively small part of the global LNG business. Most of it's long-term contracts in one way or another with some redirection of cargoes. This has been just tremendously disruptive for them. Qatar is 20% of world LNG supply, so Australia is something similar. The United States has been rising rapidly, now the dominant LNG supplier. Before the crisis, people were worried actually about excess supply in the global LNG market, partly because you have this European policy to move away from gas that will continue forward. Now you've got more uncertainty around whether you would expand U.S. capacity or whether, as the Strait comes back, basically Qatar will come back, and then there's this risk of oversupply in the LNG business. So the uncertainty there is really, really massive.
And also mention that um, a not insignificant proportion of the price of most things is the cost of transporting them. And so, when transportation becomes more expensive, goods become more expensive as well. And this is one way in which rising oil prices sort of permeate through the economy. So we're not political scientists, but because of what we mentioned before about the differences in the effects of rising oil prices and rising food prices on different people at different income levels, do any of you see sort of a particularly strong political backlash amongst groups that had been supporting the administration, more so than you might think if there were, sort of other things going on that could cause a backlash? Because of course Trump, ran saying he was going to lower prices, cut energy prices in half, and so on. Maybe Binyamin, what do you see in terms of sort of the way this backlash either is or is not rising? You said that corporate leaders are concerned about, raising the ire of the president, but polls seem to be showing that, things are sinking. And then could this eventually feed in where corporate leaders become a little bit more, willing to talk about the damage that this is doing?
I mean, Democrats have found that talking about affordability is the single most potent political issue in this midterm cycle. And you're going to continue to hear that message from them. And people are going to be experiencing strains on affordability. I mean, we've already talked about the direct impact on gas and, home heating prices, for example. But oil finds its way into our clothing, into plastics, into, agriculture. It is going to raise prices in ways that people may not even appreciate are a consequence of the Iran war, but they will feel as higher prices, and they will blame the president because that is how Americans view prices. They view them as being the responsibility of whomever happens to be in power. So I think that you have to see that as a negative for Republicans in the fall elections. Whether you're going to see corporations be more vocal, I really don't think so. I really think as long as President Trump is in power and continues to demonstrate that he views the power that he holds as an instrument for rewarding his friends and punishing his enemies, corporations have very strong incentives not to become more outspoken or politically active on these issues. But I do think that you're seeing clear signs that, parts of, if not President Trump's base, then portions of the electorate that voted for him have soured on him because they're not getting what he said he was going to deliver. Which was a better cost of living, a more affordable life. And specifically, there's a portion of the Republican electorate that thought that this man was an isolationist and that he was not going to bring the United States into new wars. And the fact that he has repeatedly done that, they view as a breach of contract. And so for them, this also is a betrayal and a consequential one.
Yeah, and I mean, when Joe Rogan comes out and raises question about you, I think you know that the tide is maybe turning. Party discipline for the politics here, party discipline is incredibly important. The problem the Democrats have had is lack of party discipline and message. Now they plausibly are on one. The asset the Republicans have had has been control over branches of government and party discipline revolving on the president. To the extent that people start to think the president doesn't have that control, it'll erode very, very quickly.
Nick, you have an expertise in uncertainty, and as you mentioned, there's a lot of uncertainty even well before this. To what extent is this just like, increasing it a marginal amount, or do you think that this is an important step up in the amount of uncertainty that people are facing?
I kind of have two views. One is the event itself is material but not massive. So if you look at stock market volatility or our economic policy uncertainty index, it jumped up, but it's nowhere near like the financial crisis or COVID, for example. So far, it seems less than the Ukraine-Russian war in terms of the response of markets and indices. My bigger worry is more that the current administration has a playbook of just throwing things out there all the time. It's like dominate the headlines. So, for various reasons, Trump seems to want to dominate the headlines, but it's hard. It's like, one of these aging rock stars that wants to keep getting number ones. It's hard to stay up there. And so he's just doing more and more events. And so it makes me kind of fearful what we see in the next 3 years. If you look back over the last year, there's been a huge number of kind of shocking headline generating events, of which obviously the attack on Iran and possible invasion is, one part of it. So I'm more worried about a persistently high level of uncertainty, because as we saw from Brexit and a couple of other events, persistently high uncertainty year in, year out is particularly damaging because businesses get used to it. They basically raise their cost of capital. Formally businesses have a return on every investment, every hire they have in mind. When uncertainty is higher, that return goes up, and so they're more likely to pause. So that, I think, is the more damaging long-run effect.
Yeah, and Michael, also we're only 3 weeks in. Mm-hmm. This could easily be as bad or worse as Russia, Ukraine. The Iranian regime is horrific, has caused all kinds of problems in the region. I thought Bernard Hakel's interview in Bloomberg about a week or so ago was really insightful. I mean, the regime is entrenched, and so we could end up declaring victory and cargoes could resume to some degree, prices could come down, it could kind of seem normal, and yet you've got this kind of stinking mess in Iran that has these spasmodic periodic eruptions that cause trouble in the region. It could go on for a long, long time in that sense and create lots of uncertainty in the region.
Yeah, think of it as lighting fires. I mean, this thing, you've lit a fire and it may not go out. And if you then light another fire and a third fire and a fourth fire, at some point you've got 20 fires smoldering still. And so that's kind of uncertain.
As someone who's got a fire in their office here, I'm a little cautious about that particular metaphor, but you're right, Nick.
So, David, you're doing that to save on oil?
No, I didn't have oil heating before, but it certainly works.
We had a question. There was a Reuters headline from about 5 days ago. Iran tells the world to get ready for oil at $200 a barrel as it fires on merchant ships. The question is, can you talk about the various best and worst case outcomes regarding this potential increase of oil to $200 a barrel? I'm not sure how much of a concern that is to any of you, since the price did spike and now seems to have come back down.
Well, I mean, I'll say just on the market side,
yeah,
you don't predict single points, you predict probabilities. And so there's some non-zero chance of oil prices at high levels like that. Sustaining at high levels like that seems hard, but not impossible. More likely outcome is a lot of volatility. And frankly, given all the disruption, it's actually amazing that how markets have addressed this, and the prices are still, within the range of things that we've seen from other kinds of crises, and price spikes. Think about 2022. Think about the eve of 2007, 2008. So sustained at 200, really hard. The warnings of prolonged uncertainty in the Strait of Hormuz, and, NATO can't get itself together, and we can't coordinate the mind. It's not so much that we can't do that. We practice this all the time. But it's doing this under real wartime conditions, possibly with an environmental crisis of one or more tanker actually spilling load. I mean, in that kind of world, you could imagine this going on for quite a long time.
Uh, did you have a question? Sorry, Michael.
Well, there have been a number of questions that I've seen about could this boost green energy?
Mhm.
And we talked about that a little bit before. If oil was $200 a barrel, as Benjamin and David and Nick have said, that would really help boost green energy. But do any of you think that given the volatility, no matter where the price, more or less, no matter where the price ends up, just that it's so volatile and we know that these things can happen, or it's made more apparent once again that these things can happen, could that uncertainty and volatility itself help boost green energy?
Yeah, I mean, I think every major economy, but for the United States right now, the lesson they're learning from this is we better, double down. In the 1970s, we doubled down not only on green energy, but also nuclear and coal. I don't think we're going to double down on coal. The long-term prospects for coal almost everywhere are kind of an undulating and slow decline or rapid decline, as we've seen in the United States and Europe. So I think overall, this is going to be good for green energy. It's also going to be very good for nuclear power. And already we were seeing the actual nuclear renaissance is happening now, where we're seeing new interest in building new reactors, all these small modular reactors. It's going to take a while, but the interest in using electricity, at least to tamp down dependence on imported fossil energy, including oil and gas, that's certainly been boosted.
David, following up on that, you had mentioned before that in the United States, the administration is saying, well, this is evidence that we have to, have more oil produced in the United States. But because it's a world market, is there any way in which the oil production in the United States could actually be big enough to, in any significant degree, temper the rise in prices?
It already is. I mean, you think about all of that oil that's coming out of the U.S. is basically adding a huge segment into the supply curve, some of which is variable. It depends on the price of oil. So we will see some higher cost, generally low productivity wells come online because of high oil prices, and then they'll shut down when prices come back down. So actually, I think already the United States is playing that role. This is, I think, one of the challenges politically is that the United States has both sides of the ledger here. We have the cost of the war, but also, for at least for some segments of the U.S., including Texas, as to our earlier questioner, the U.S. at least benefits in the short term.
But the U.S. couldn't be like Saudi Arabia was in OPEC, where it sort
No,
of,
no,
was
no.
right.
There's a lot of reasons. I think there's a lot of reasons why we're not going to run our own OPEC. And the Saudis and the Emiratis are the backbone of OPEC. They have relatively low cost oil that they have a strong incentive to run a cartel that, frankly, its efficacy is always overstated, nearly always overstated. We've been, in the tailwinds of that. Other oil producers, Mexico, Venezuela, have been in the tailwinds of that. Russia, to some degree, we're definitely in the tailwinds. Sometimes they actually help out in running the cartel, but I don't see the U.S. as a matter of reliable national policy. You might occasionally have somebody say, "Oh, we should do this," but reliable long-term national policy do this. I see that as, of all the predictions that are hard to make right now, that one seems pretty easy.
Geopolitically, the consequences here for Venezuela in particular are really interesting. That's a country that has been producing at a relatively low level relative to its reserves. You've already seen U.S. companies expressing an interest in making large-scale infrastructure commitments there to increase production. It's a very obvious counterweight to the uncertainty in the Middle East, and I would expect you'll see that as a Trump administration policy and as a focus of U.S. investment in the coming years.
Well, we are at time, and but we do have one question, which is sort of a good question to end on, and maybe each of you can speak to this, or perhaps any other thoughts that you want to close on. But do you see an exit strategy for the U.S.? I'll just leave it at that, and you may each talk about that, or any other thoughts that you want to end on.
Well, I could start. I mean,
Sure.
yeah, we could just exit. Well, plausibly, that's what we're going to do, or try to exit. My big concern is obviously on the way out, we're leaving a real mess that will keep us there. And the mess is not just on the ground in Iran, it's in all of our allies and partial allies in the region. And the mess is the ongoing stress in our international cooperative arrangements, whether it's NATO with regard to teaming up to clear the Strait of Hormuz, keep it clear, or it's the lack of coordination before this on oil releases. I mean, that's the real the lack of confidence in the U.S. role. That's the real mess here.
Um,
Yeah, I would follow up on that and just say we're not going to go back to an antebellum world here. That, with all of the disruptions of this administration, this is one that in many ways affected more countries more deeply. And the lack of confidence in the United States, once you've broken it, you can't fix it again. So I think, when we think about, well, the war could end, we could declare victory and leave, the world will be a different place in many ways after this than before. And we shouldn't just sort of think about, well, we'll go back to what it was before these hostilities.
And I would
uh,
just note that the United States doesn't have the power to end this conflict unilaterally. There's another participant here with its own incentives, its own goals, which is Israel. And, there are scenarios in which Trump decides he's done and Israel and Iran decide that they're not. So this is more complicated than just what we want to do.
and I think there isn't, I'm not clear there's any strategy. I mean, that's part of the issue. That this is the costs of firing much of the CIA, getting rid of much of the administration, government. So, is there an exit strategy? Hard to say. Was there an entry strategy in the first place? It's hard to say either. That's part of the problem. I'm not sure there was a strategy. I think it was the decision of one person motivated by things we're not entirely clear about.
Right, right. Well, we will leave it at that. This has been a really insightful hour, and I want to thank you all for being here and for doing this. We will have the video up as soon as we can. Go to journalistresource.org or econofact.org and sign up for our newsletters to be sure to get that video if you would like to watch this again. Thank you all again. Thank you, audience members, for being here. And we will see you next time. Thank you
Thank
again.
you.
Take care.